Hello and welcome to this Accounting 2208 Chapter 17 video lecture that will cover EPS. This video will cover some of the basics on the steps involved in calculating basic and diluted EPS and review those steps through exercises 17-1 and problem 17-9 from the textbook. So what we will cover in this video includes a review of the steps involved in calculating basic and diluted EPS. I'll also provide a brief note on options, warrants, and rights, and then we'll go through a couple of demonstration problems, specifically exercise 17-1, that's Manfred Manufacturers from the text, as well as problem 17-9, Twilight Limited, also from the textbook. All right, so we will begin with going over the steps in calculating diluted EPS. And please watch and take note of these steps very carefully, because if you don't do them correctly, you won't get the right answer. So the first thing that you have to do is calculate the weighted average number of common shares, also known as the WACS, and we'll show you how to do that. Then you would calculate basic EPS, and I'll show you how to do that. And once you have determined basic EPS, then you must go through and determine the individual impacts for all potentially dilutive items. So that would include convertible share, preferred shares, convertible bonds, and stock options, warrants, or rights. In cases where options, warrants, or rights are in the money, we'll talk about in the money, you calculate the assumed repurchase of shares, also known as free shares or the treasury stock approach. A lot of students miss this. This is a kind of a really important step here. I mean, they're all important, but then once you've looked at the options, warrants, or rights, you must rank potentially dilutive items, right? And the neat thing is that options, warrants, or rights are always ranked number 1. All right, and then all other potentially dilutive items are ranked from lowest to highest per share impact, and I'll show you how to do that. The sixth step is to calculate a diluted EPS using a staged order of entry approach. Students don't do this, and what happens is they make mistakes because they include the calculation of a subtotal at every step to test for anti-dilutive items, because an item that may be potentially dilutive in step 5 may become anti-dilutive as part of the diluted EPS calculations. Then you must provide a full income statement presentation for basic and diluted EPS, and that also includes accounting for discontinued operations if it exists in a problem. All right, so these are areas where students lose marks. I just want to take a moment to provide a brief note on options, warrants, or rights, because students usually get confused between them, and really there's not a lot you have to know about them. They're treated the same way, but in case you're wondering about the difference between them. So share or stock options gives the option holder the right but not the obligation to buy or sell a stock. In our context for earnings per share, it's about buying a stock, right? Because if somebody buys the company's stock, it will increase the number of common shares. We're not concerned about options to sell stocks. Anyway, so it gives the option to buy shares basically at an agreed upon price, and that's usually called the exercise or strike price. All right, and now options are commonly issued as part of executive compensation, but they can be purchased separately, sometimes through the open stock market, right? So usually executives will receive stock options as part of bonus, right? And those options then executives can then, and employees as well, can then purchase shares at a certain price if they so choose. Warrants give the holder the right but not the obligation to buy or sell a security at a certain price, right? This exercise a strike price. Well, guess what? It's exactly the same definition as an option, except that warrants are commonly included in share issues and bond issues, and therefore can be detached from the bond. So we used to cover complex financial instruments where you'd have a bond that included some detachable warrants. And usually with warrants, you need a certain number of shares plus some cash to be able to purchase the common shares. With options, it's just straight cash. You don't need to own existing shares, right? But in essence, for the treatment of earnings per share and diluted earnings per share, Options and warrants are basically treated the same. And then a stock right, guess what? Gives holder the option, but not the obligation to purchase, right, a predetermined number of shares at a predetermined price, similar to a stock option or warrant, right? They're typically distributed to existing shareholders, right, who have the ability to trade them. So we could say that options are usually part of compensation. Stock warrants are part of existing, are part of new share or bond issues. And stock rights can be distributed separately to existing shareholders. And that's pretty much it for the difference between options, warrants, and rights. Now this piece here is the most important part that you need to know for EPS in this course. Basically, options, warrants, and rights are always dilutive as long as they are in the money. What does in the money mean? Well, that means that the strike price or the exercise price is less than the average market price. So if you have the opportunity or the option to buy a share at 50 cents, right? And the average market price of the share is $1, well, you'd be crazy not to pay 50 cents for something worth $1, right? Therefore, the options or the warrants or rights are in the money. Now, if the reverse is true, if you have an option to pay $1, but the market price is 50 cents, well, you've got to be pretty crazy to exercise that option. So in that case, they would be out of the money, right? The other thing to remember is that there is no impact on earnings. All options do is increase the denominator, right, through an increase of weighted average common shares. So the company, there's no earnings impact. It doesn't change the earnings available to the common shareholders, as you'll see, right? So for example, with bonds, if convertible bonds are converted into shares, then there is interest saved. Well, the saved interest increases the income available to the common shareholders, right? Well, in the case of warrants, options, and rights, there's no increase in income or decrease in income. So there's a zero impact on the numerator, but the exercising of these items will always result in more shares. So it increases the denominator, but never the numerator. And that's what makes them always dilutive and fully dilutive. And as a result, they're all tied for number one in the ranking in diluted EPS calculations. So if you have a question that has options and warrants or warrants and rights, it doesn't matter in the ranking which one you put as number one or number two. They're basically all tied for number one or number two or whatever. It's the other items, the potentially dilutive items like convertible bonds and preferred shares, that we have to be careful for in the ranking process. All right, so now let's get down to it with some demonstration problems. So let's look at E17.1, Manfred Manufacturers. So on January 1st, 2017, change that, January 1st, 2017, right, the company had 300,000 common shares outstanding. On April 1st, they issued 30,000 common shares to raise more capital. And on July 1st, they declared and distributed a 10% stock dividend. Then on November 1st, the company repurchased 10,000 of its own common shares to make them available for issuances, right? So those are the most important items. So our objectives here are to calculate the weighted average common shares at December 31st, 2017 for part A, and then B, we're going to change it up a little bit. Assume that the company had a 10-for-1 reverse split instead of a 10% stock dividend on July 1st. And we'll do the same thing, calculated the weighted average common shares. Right, it's a very basic problem, the only purpose of which here is to calculate the weighted average common shares. All right, so let's go ahead and solve this bad boy. Let's first begin with reviewing the formula for basic EPS. It's net income minus preferred dividends, but here's the thing to watch. All right, if dividends are in arrears, we do not include prior year dividends. So do not include prior year dividends if we're talking about the only way we'll have dividends in arrears is if they're cumulative, right? If the preferred shares are cumulative. So if the preferred shares are cumulative, right, we do not include dividends in arrears. So current year dividend only. And that's even if it's not declared, by the way. Now, if the dividends are non-cumulative, we would include the preferred dividends only if a dividend is declared. Okay, so watch out for those common mistakes students make. So basic EPS is net income minus the preferred dividends divided by weighted average common shares. And now we'll show you how to calculate the weighted average common shares. Easiest thing to do is set up a little table. So we'll include a table for dates, include a table for the outstanding, a column for number of shares, a column for something that we'll call the restatement, right, that deals with splits and stock dividends. Then include a column for the fraction of the year that particular number of shares is outstanding, and then we end up with the weighted shares. So we had at the beginning of the year 300,000 shares, and those shares were in existence from January 1st until March 31st, okay? Because it was on April 1st that we had our next event. So for that period of time, 300,000 shares outstanding, right? For a fraction of 3 over 12. But at some point later on down the road, and usually when I teach this in class, is I leave this restatement blank initially, and then fill it in later. But so just pretend we didn't see this just yet. So I would just put January to March 31st, 300,000 shares. It gives you 312, and then leave the totals out for the moment. Then on April 1st is when we have the additional shares. So there's 30,000 more shares issued, resulting in a total of 330,000 shares that were outstanding for April 1st to June 30th, right? And that April, May, and June is another 3 months, all right? So hold on with the totals here. So just bear with me. So the blue and the green just omit for now, right? Again, you'll see why I want to do that in a minute. Then on July 1st, that's where there's a 10% stock dividend. So 10% stock dividend. And so when we multiply by 330,000, if we take that and multiply by 1.1, which is an additional 10%, we end up with a total of 363,000 shares, right? And those shares are outstanding for the period of July 1st to October 31st, and that's a period of 4 months. Now we can include the restatement, okay? So at this point, 363,000 shares times 4 over 12 is 121,000 shares. But this 10% stock dividend needs to be applied retroactively. And so, because, and only to points prior, right? Because if we don't restate previous periods share balances, it's like comparing apples to oranges, and we need to compare apples to apples because as of July, we've basically increased the float of shares by 10%. So now is when I would in class go back and say, okay, for all periods prior to the stock dividend, now multiply times 1.1. So if we go back to January to March, the 300,000 beginning shares times 1.1 times 3 over 12, that gives us 82,500 weighted shares for the period of January to March. Then for the period of April to June, that 330,000 shares we calculated times 1.1 times 3 over 12 is 90,750 shares. Right? So you see why I wanted to leave those blank to begin with and then apply those retroactively. And so at this point here, you see once the period that has the stock dividend, there is no restatement because we're including it in the calculation of those number of shares. Then on November 1st, there's the reacquisition of shares. So we subtract 10,000 because the company bought 10,000 shares back. So at that point, there are 353,000 shares. There's no restatement, right? That's why this is blank. And multiply by 2 out of 12 shares is 58,800, 2 out of 12 months, not shares, is 58,583. And that's for the, right, November plus December is 2 months. So when we add them all up, the total weighted average common shares is 353,038. And just to make sure you did this right, I would add up 3 plus 4 plus 2 is 12 over 12 months. And that's how you calculate weighted average common shares. Remember, part B was a variation here. We had a 1 for 10 reverse split, right? So I've made this table a little bit prettier, and all I've done here is included a column for the event, but you don't have to do that. But anyway, let's begin. So for for January 1st to March 31st, there's a beginning balance of 300,000 shares, and that's a fraction of 3 over 12 months. Then the company issued 30,000 shares, so here we will add 30,000 shares. That results in 330,000 shares, and that period of April plus May plus June is 3 months. But then here is where that reverse stock split was, right? And the 1 for 10 is basically we divide by 10, or we can multiply by 0.1, right? So that gives us 33,000 shares that were outstanding for 4 to 12 months, July plus August plus September plus October. But now it's at this point that we have this split that we need to apply retroactively. So I would restate the prior periods as well by multiplying by 0.1, right? For both. Oops, so times 0.1. Now I can go and fill in the results of the line items. So 300,000 shares times 0.1 times 3 over 12 is 7,500 shares. For the second event, 330,000 shares times 0.1 times 3 over 12 is 8,250 shares. Then, of course, the reverse split, there is no restatement, times 4 over 12 is 11,000 shares. And then in the last period, the company acquired its own shares, so we would take off or subtract 10,000 shares, giving us 23,000 shares, no restatement because we're not going backwards, times 2 over 12 is 3,833 shares, and so those add up to 30,583 weighted average common shares, and we've solved part B of E17.1. So now let's move on to P17.9. This is a bit of a bigger problem. So what do we have here? The company has notes payable, convertible bonds, 4%, convertible 6% bonds. See, these are the important ones. Those notes payable, meaningless to us. It's these 4 and 6% convertible bonds because they're convertible into common shares, right? Those we'll have to worry about. In terms of shareholders' equity, we have 68-cent cumulative convertible preferred shares, right? We have common shares, of course, right? And really, at this point, the number of shares issued and outstanding, other than to help us figure out the weighted average common shares, the number authorized really is not important. This is just reviewing full presentation. There's contributed surplus and retained earnings balances, but those are actually meaningless for us. But there's some keynotes and assumptions here, so we have to be careful. So their options were granted in 2016, giving the holder the right to purchase 100,000 shares at $8 per share. And the average market price, that's important too, was $14, right? And the exercise, expire in 2025, okay? 4% bonds were issued in 2016. There's 6% bonds that are issued in 2017. They have a face value of $1,000 and are convertible into 100 shares. That's important, okay? Because we have to do some calculations there. The convertible preferred shares were issued at the beginning of 2017, and each preferred share is convertible into 1 common share. The tax rate is 25%. The common shares were outstanding during the year. So this is a simplified problem where we don't actually have to calculate weighted average common shares to start with, so we don't need to do step 1. It's done for us. No dividends declared in 2017. Net income is $2.5 million. No bonds or preferred shares were actually converted in 2017, so that helps because we don't have to do fractional conversion. In terms of why this information is important, let's see. $8 per share, whoops, I want to do that. The $8 per share, sorry, I have to re-highlight that. Go with my pen. The $8 per share versus the $14 per share will help us determine that the shares are in the money, right? In the money, because the strike price is less than the market price, so they are dilutive, right, to be in the money. We need the tax rate to calculate the interest after tax. The interest savings actually have to be calculated. I'll just write this again. The interest savings on the convertible bonds, right? That's the only thing we need the tax rate for. So our objective here is to calculate basic earnings per share, of course, calculate diluted earnings per share, and then a couple of qualitative questions in order to say from a shareholder's perspective, support for the treatment of preferred dividends, right? So basically to review how he treated the preferred dividends and why, and then discuss how a shareholder's investment decision may be affected if the diluted EPS was not reported. All right, so now let's look at solving part A, basic EPS. Remember, the weighted average common shares was already provided. And that was basically 3 million shares, 3 million. So if you're looking for step one, we don't need to do it. Basic EPS equals net income minus preferred dividends over weighted average common shares. The net income was $2.5 million. And then we have to subtract, right, the preferred dividend. So and the reason why is because this is a cumulative preferred share, right? So there are 600,000 preferred shares that are outstanding. And even though no dividends are paid in previous years, and this is a cumulative preferred share, we only look at 1 year's worth of dividends that would have to be paid at some point. So 68 cents, right? So we take 2.5 million minus 600,000 preferred shares times 68 cents gives us $2,092,000 in earnings available to common shareholders. There are 3 million shares, so the basic EPS is 70 cents per share. That's nice and easy. Step 2 is to do the individual impacts of the warrants, options, and rights, the bonds, and the preferred shares that make up potentially dilutive items. I always like to start with options, warrants, or rights first to get them out of the way. All right, so let's deal with, and there are only options in this problem. So what do we know about these options? The strike price or exercise price is $8. The market value is $14. Therefore, they are dilutive because they're in the money. If this was reversed, if the market price was $8 and the strike price was $14, they would be out of the money and you wouldn't even bother worrying about them at all. All right, but that's not the case here. So because the options are in the money, it's assumed that the option holder would take advantage of it. I mean, why wouldn't you buy something that's worth $14 for $8? You'd be crazy not to, right? So what happens here is that the company will then issue an additional 100,000 new shares, okay? But here's the part that students always forget. It's this part right here, the repurchase. It's basically an assumed repurchase. So this is the free shares or treasury stock approach that I'm describing here. Okay? So it's assumed that because the option holder will exercise the option, the company will then take the money from the stock option issue and automatically go to market and repurchase however many number of shares they could buy at the average market price. So assuming the option holders will take the deal, there'll be 100,000 new shares. At $8 a share, the company will receive, right, $800,000 in cash. They would immediately go to market and repurchase, right, however many shares they could buy at a market price of $14. Well, that happens to be 57,143. So even though the company will issue 100,000 new shares, we assume that they will go and repurchase immediately 57,143 shares to result in the net increase in common shares of 42,857. This is the piece that students always miss. Don't forget the assumed repurchase of shares. You do that, you're golden. Next, we'll deal with the 4% convertible bond, right? So you could go with the 6% bond first. It doesn't matter. The order here doesn't matter. So there are $2 million in bonds that pay 4% interest. So if those bonds were converted, the company would save $80,000 in interest expense, right? Because interest is tax deductible, right? Now, or because interest is tax deductible, we have to multiply by the tax rate, right? Or rather the after-tax rate, right? So if the tax rate is 25%, the after-tax rate is 75%. After-tax is 75%. Students miss this as well. They forget about the tax, right? And I'm showing here it's multiplied by 12 over 12 because, now here's the other thing too. There were no conversions during the year. But even though the bonds were not converted, it's assumed that they would be converted, right? And it's because they're actually convertible in the future. And it's the same thing with the options too, by the way. I forgot to mention that. It does not matter when the options are convertible. It could be 5 years from now or 1,000,000 years from now. They are all still included in the calculation. So the diluted EPS assumes the absolute worst case scenario of all potentially dilutive items being converted all at once. Okay, so and because there were no conversions during the year, so the entire year is outstanding, right, in terms of the effect of the bond, because it's assumed that conversions would take place at the beginning of the year. So if the convertible bondholders converted their bonds, it would be assumed that they convert them on January 1st, and we would save a full year's worth of interest. That's why this is 8 over 12. If bonds were actually converted during the year, let's say on July 1st, right, then the interest would only have been saved for the last half of the year, right, the period for which the company does not have to pay interest on bonds, right? So at the end, this means that the company will save or add to earnings, the numerator, $60,000 after tax as a result of converting those bonds. So the green is the dollar impact. Now we have to calculate the numerator or the number of share impact, right? So what happens here is if those 2 million in shares are converted, we know that each $1,000 bond, or each bond is worth $1,000. So by taking the total dollar value of the bonds, $2 million, divided by the value of each bond, $1,000, that means that there are 2,000 bonds. And based on the information, right, each bondholder can convert into 100 common shares. So this means that there's 200,000 additional shares as a result of that conversion, right? So the individual impact of converting the 4% bonds takes the earnings impact over the dollars over the number, $60,000, right? This is here, divided by 200,000 shares is 30 cents. And then what we can do is we compare that 30-cent individual impact versus the 70 cent basic EPS to determine if it's dilutive or not. And because the individual impact of 30 cents is less than the basic EPS, it is dilutive, and therefore we will have to include it in our overall dilutive EPS calculations. Not doing this individual impact will hurt you because you can end up with something that's anti-dilutive. Let's say that the numbers that we did here ended up with, instead of 30 cents, ended up with 80 cents. Well, 80 cents is more than 70, and this would be anti-dilutive, and we would not include this item. So we're going to include the item, but we don't know the ranking order just yet. All right, so now we're going to look at the 6% bonds. I'll just use a different color pen here. There are $3 million of this 6% bonds, right? Right. So that means that the interest would be 6% of $3 million times 0.75. Remember, this is the 1 minus 0. Sorry, let me make this look prettier. 1 minus 0.25, that's the after-tax rate, times 7 over 12, right? So what happens here is these bonds were converted, right, 5 months into the year on June 1st, right? So that the interest is saved for June all the way to the end of the year. So that's why this is 7/12, right? Number of months the interest was saved. Okay. So $3 million times 6% interest times 0.75 times 7 over 12 means that the shareholders, the common shareholders, would see an extra $78,750 added to the earnings. And then we know that the $3 million of total bond value, that the each individual bond is $1,000. So that means that there are 3,000 bonds outstanding that are converted into 100 shares. And we would also have to apply the same fraction of 7 over 12 here, right, to help us impact the weighted average number of common shares, right? Because by doing this conversion, right, that means that this number of shares would be added, or would be added to the total number of shares, but only for 7 out of 12 months of the year, right? Because that's how long they would be there. So that's 175,000 shares. So 78,750 divided by 175,000 shares is 45 cents per share. Well, that 45 cents is still less than the basic of 70 cents. Therefore, we include this one as well. Now we will look at the preferred share impact, right? What do we know about the preferred shares? There are 600,000 preferred shares that pay a dividend of 68 cents. Well, if those preferred shares were converted, right, it would be assumed that they would be converted at the beginning of the year. The company would save, right, 1 year's worth of dividend, not arrears, no arrears, so would save $408,000 in dividends if they were converted at the beginning of the year. And we know that there are 600,000 preferred shares, and each one is convertible into one common share. That's what this is. This is one common share, right? So that means there would be 600,000 new shares. So the individual per share impact is 68 cents. Well, that 68 cents is still less than 70. Therefore, this is potentially dilutive, and we would include in our calculations as well. Now our next step is to go through and do the ranking of these items to help us calculate diluted EPS in the correct order. So we have options, we have 4% convertible bonds, we have 6% convertible bonds, and preferred shares. Now what I said earlier on is that options, warrants, and rights were always ranked number 1. So this is number 1. Which leaves me the 4% bonds, the 6% bonds, and the preferred shares. And our ranking is always from, so we rank from lowest to highest per share impact. Per share impact, right? So I look at these and I go, hey, the 4% bonds are 30 cents, the 6% are 45, and the preferred shares are 68. Well, 30 is the lowest, so this will be ranked number 2. Then of the two left, 45 is less than 68, so the 6% bonds are number 3. And that leaves the preferred shares as number 4. Right? So that is the correct order to do the next step. So now I'm going to illustrate how to calculate diluted EPS using the proper order of entry approach. And you must do it this way. If you don't do it this way, you will get the answer wrong. I guarantee it. So what you can do is put together a quick and dirty table that has 3 columns, right? One is for the dollar impact, right, which is the numerator, the earnings impact, right? So I'm going to put a little n for numerator. The number is the number of common shares. That's the denominator. And then a calculated EPS. And we also always start, our first line is a restatement of what the basic EPS is. So we know from our very first step, right, basic EPS $2,092,000 divided by 3 million shares is an EPS of 70 cents. Now I insert my first ranked item, the options. Notice that with the options, there is no earnings impact. There is no savings of any interest, so there's no number added to the earnings, right, for the earnings per share. But there is an additional 42,857 net shares added, right? And that's the 100,000 shares on the options minus the assumed number that's repurchased. Now, here's the step and why you have to do it this way is because after every item, you must calculate a subtotal. So $2,092,000 plus no earnings impact still gives us $2,092,000. The number of shares is now 3,042,857, which equals 69 cents. The reason we have to do that is now we compare the next item, the next ranked item, which is the 4% bonds, and compare its per share impact to the subtotal. If you don't create the subtotals, you won't get the order right, and you won't be able to determine if something becomes anti-dilutive. So pay attention as we progress through this. The next ranked item is the 4% bonds. Because the individual impact of 30 cents is less than the new 69 cent subtotal, we can continue to include it. So we will add $60,000 and 200,000 shares. So the new subtotal, this is a new subtotal, now $2,152,000 and 3,242,857 shares. Taking dollars divided by number, that's 66 cents a share. This is our new comparative for the next step. The third item is the 6% bonds. Their individual impact was 45 cents, and that is less than 66 cents, which is the most recent subtotal, so now I can include these. I will add $78,750 to give a total of $2,230,750, and I will add 175,000 shares to give me 3,417,857 shares, giving me a new subtotal of 65 cents. Now watch this. The fourth ranked item was the preferred shares, but guess what? Those were ranked, not ranked, the individual impact of those is 68 cents. Well, 68 cents is more than 65 cents, so you do not include them. We stop at the 6% bonds because the preferred shares become anti-dilutive. And look at this. As we go down from the basic EPS, the first level, it drops from 70 to 69. Then from 69 to 66 and 66 to 65. You see how the diluted EPS continues to become smaller and smaller. If you ever see the subtotal go up, it means you've made a mistake or you've included an anti-dilutive item, because if we include the preferred shares, the basic EPS will go above 65 cents. And we can't have that. Diluted EPS is the absolute worst case scenario. So the subtotal needs to keep falling after every item. So the answer for our the next step is the presentation, because we would stop here, right? So I'm going to draw a big line here. We stop. So our income statement presentation looks like this: 2 columns, basic and diluted. We show EPS, 70 cent basic and 65 cent diluted EPS, and that is the full presentation. Now this question does not have discontinued operations, so we don't need to list it. The next problem, the Simpson problem, will have a discontinued operation, so you need to show that a little bit separately. You have to show that separately, and you'll see how that works. All right. Now we've been asked to consider a qualitative response here in the treatment of the preferred shares. There's really more here than you need to know. Preferred shares were not declared in 2017, but 1 year of dividends on the convertible preferred shares was deducted to arrive at the income available for common shareholders, right? And that's because convertible preferred shares are cumulative, and that means that the annual dividend not paid must be paid in a year later, right? So in calculating the diluted earnings per share, we have to include the effect of converting the preferred share to common share, right? And it was determined that the conversion of preferred shares would not reduce, so this is here, it was determined that the conversion would not reduce earnings per share, and the only reason for that is because they were anti-dilutive, right? Anti-dilutive. Well, we would not have known that they were anti-dilutive if you did not go through the whole process of calculating the diluted EPS, right? So as a result, the effect of converting preferred shares was excluded in the calculation of diluted EPS. So that's the answer to this question, right? Because we went through the process of determining the individual per share impact of the preferred share, then taking the proper steps in the right order to calculate the diluted EPS, we determined that because the preferred shares actually became anti-dilutive, they would be excluded from the calculation of EPS, right? And therefore, the preferred dividend was deducted from the income available to the common shareholders, but did not affect earnings per share. And at the end of the day, the shareholders, the common shareholders, of course, need to know how much of the company's available income can be attributed to shares they own, right? To help them assess future dividend payouts and the value of their common shares, right? So the effect of cumulative dividends on preferred shares must be carefully considered in calculating basic and diluted EPS. That's why it's so important. In terms of question D, the decision-making impact, well, think about it. If you're a shareholder and if you don't see the EPS, right, you would, if you didn't see diluted EPS, all you would see was the basic EPS. And that would not reflect all of the potentially dilutive items, right? So if all of the convertible, and here's the thing, is that so many shares are issued as options, right? And companies do all kinds of things that could potentially increase the number of shares. Well, if you're a shareholder and you don't know what the impact of all of those options and conversions and stuff would be on your shares, right? Because it dilutes your ownership, right? So you need to know that. And if we don't show diluted EPS, it wouldn't reflect the adverse effect of all those conversions, right? EPS is also used in the calculation of the PE ratio, by the way, which is the market price divided by EPS. I don't think I think we have to know that for this one. Look in the omissions list to see if that's excluded. But even so, any good accountant should know that the price to earnings ratio is just the market price divided by EPS. Very simple, right? And diluted EPS should be presented on the statement to provide a calculation of EPS comparative to market price. So it's very important as a shareholder to know what the potentially dilutive impact of all of those conversions would be on your ownership in that company. So this concludes the Chapter 17 EPS video tutorial. I hope you found it useful.